So today we're going to be talking about working with accountants, year-end files, taxes, financial statements. There have been some changes and not every accountant is keeping up with those changes. So that we'll go over that to a minor degree today. So I am Jonathan Carter, recent CPB. So I just passed that a couple of weeks ago. I was pretty excited about that. Ironically, I was going back to check my answers and accidentally submitted. So I'm really glad that I passed because I hit the button by mistake. But I am the founder of CATA Accounting Solutions Professional Corporation. We are a registered CPA firm in Ontario. We do not do public accounting assurance work, so we don't do reviews or audits, but we'll do like compiled financials, tax consulting, Section 85 rollovers as people go from sole prop to corporation. And we're very, very well networked, and we love to connect prospects with the right type of bookkeeper to help them. So, we do, if anybody has a niche, I was lucky enough to have a good meeting with Karen a couple of weeks ago and got to learn about her niche. So those kind of things are really important to us because we love to make sure that the prospect ends up in the right home. We do bookkeeping, but we try to stay in our lane and we try to stay focused on the niches we want to work with. So I was a member of the inaugural Intuit Accountants Council. I have been working with Intuit for several years in various different little things. I was the recipient of the 2018 Inspire Accountant Award. We're Elite Pro Advisors. I am QBO Advanced Certified, as is several team members. Everybody in our firm must be QBO Basic Certified. Even our marketing coordinator, who never does any bookkeeping but her own, she has to get QBO Basic Certified. I did make the Insightful Accountant Top 100 in 2021 and 22, and I do work with several cloud bookkeeping firms and am commonly considered a thought leader in technology and accounting. So I'm just going to move my toolbar out of the way. Keep going. So today, this is just a quick agenda. The top thing that I find is sometimes people don't understand what they need. So that's the first thing we're going to talk about is what is the type of engagement that is required. Now, we're going to talk about a lot of things that would have appeared on the creating a beautiful year-end file that we did previously. I think it was a year ago or so, but we're going to revisit a lot of those things. So I apologize if it's a bit repetitive, but now is a great time for a refresher on these things. So let's go to poll question 1. Which type of engagement requires the accountant to review all of the transactions to ensure that they're correct? I think only...
Just a minute.
We need to make this
Okay.
successful to panelists.
Newbie here. I'm very sorry.
I'd say you're doing a great job on the fly.
How do I do this? Everybody bear with me.
It went away.
It went away and I hit allow panelists, but now it wants me to share results.
Oh.
So, okay, I'm gonna ask you all.
Do it again. Only 2 people answered.
If everybody can just throw
In
the
the
answer in the chat.
I'm sorry.
Oh, okay.
I'll wait until I see those chat answers and I'll weigh in.
And you have to answer both in order to get your CPD credits.
Perfect, thank you.
Okay. Kathy, well done. Well done. This is a commonly misunderstood area. There is no level of engagement that requires the accountant to review every single transaction. I can't even imagine what the cost would be like on that type of engagement. So yes, this is true. None of the above of these require the accountant to review all transactions. Yeah. So what does the client need? Let's talk about this first. Do they need assurance? This sometimes can be dictated by the bylaws. the corporate minute book. There are different reasons they might need an audited or reviewed financial statements. It might be required by grant funding. It might be required by lenders. There's a lot of different reasons this can happen. It is very important that it be done by a licensed public accountant. We are not licensed public accountants. We don't do review and audit, but we do work with them for our customers. In addition, there needs to be independence. So if this is a regular bookkeeping client of yours and you happen to have an auditor in the firm, you really need to be going outside to a different audit firm rather than handling it internally. I would check the CPA registry to be safe. It will hold up-to-date public accounting licenses, firm registrations, things like that. And I have seen several examples where people have done an audit and it looks absolutely legit, and the person does not have a public accounting license, does not have a registered firm, and things like that. It might not matter, but if it does, I think it would matter a lot and really could result in somebody, being taken to court over it. So when you do an audit or review engagement, you're getting either audited or reviewed financial statements, and then you're getting an opinion. What you want is an unqualified opinion. That means they didn't find anything material or anything that was a problem in their eyes. There are some types of companies or organizations, in particular not-for-profits, who almost always get a qualified audit. So it's like, you want an unqualified audit, sometimes it's really hard to get. But really the key is, are the statements substantially materially correct, right? That's what the audit or review is going to tell you. Now, the next level down, which is zero assurance work whatsoever, and this is the highest level of financial statement we're allowed to produce, are compiled financial statements. These are formally known as notice to reader statements for year ends after December 14, 2021. That is inappropriate. One of the key things with compiled financial statements is, who is the audience? Who's going to be reading these financial statements? There are several more sign-off steps requiring management to understand their basis of accounting and sign off that they take complete responsibility for the numbers that are contained. There's also times where just a tax return will do, and then producing financial information out of whatever bookkeeping system is being used is sufficient. Generally speaking, that information should not go to third parties. It should stay internal to the company, but usually it's designed for management to help them run the company. So just a quick upsell opportunity for those of you who do corporate tax and who do help with these kind of governance and administrative things. Do they need help with a year-end meeting? The blog that we'll be releasing soon is actually, again, back to the corporate record book. We did a webinar on that one earlier. It's the area where I find most small businesses are deficient, and it is a legal requirement. This is not you really ought to, it's best practice. This is something where if things end up in court, the corporate record book is really, really important. So keeping it updated regularly is important. For bookkeeping clients, you might be able to help with a lot of keeping them up to date. So like, contributing to those key agreements that come across your desk into their corporate record book could be one example, or even helping them understand what minutes they're going to need when they do a shareholders meeting. Are there any questions about the type of engagement that your client needs? Okay. I'm going to just keep going. We're a little bit behind. So now CPA has been very diligent about the language between financial information and financial statements. So financial information is all the underlying information, your AR aging summary, your QuickBooks output, showing the balance sheet, showing the income statement, all those kinds of things, all the agreements, all the receipts, all the bills, all the sales invoices, those kind of things. Financial statements, now this is of course CPA's definitions, are prepared by an accountant, and they're either audited, reviewed, or compiled financial statements. These can go to a third party, but they must always go as a complete package, including the letter from the accountant and the notes. There has been some feedback recently from CPA about the implementation of the new compiled financial statements. And it is important to make sure that as a bookkeeper, you're communicating well with the accountant what kind of financial basis there is in the accounting system. Are you actually using ASPE, accounting standards for private enterprise? Because a lot of people claim they are, and they're not quite. So that was one of the deficiencies that was pointed out. And another was statements without a cash flow statement and statements without notes. So those are some important things to keep in mind. If you want to, kind of vet the accountant, you can ask them if they're up to date with the latest standards for compiled financial statements. So I'm going to speed through some of this stuff. The highest level of assurance engagement is an audit. They test sample transactions. They're governed by generally accepted accounting principles, and they do have some rules they need to follow. What we do find is some of the larger firms, the work is being done completely by students and juniors. They're getting charged at a very high rate, and they're testing far more than what needs to actually be tested according to the standards. So those are interesting conversations you can have with the auditor, and you can always look up what the standards are. So if they want to test every other transaction, that's a really deep dive, and that's way beyond the standard of what is required of them. So that's something to keep in mind. What they're really looking for are the risky and material transactions. And they will have to develop a really comprehensive understanding of how the books are kept, what kind of accounting basis there is. And then, of course, they'll give you the audit report, and they'll give a letter to management. The audit letter needs to go with the financial statements always. The management report is usually for management and usually suggestions about how to do better next time, essentially. Oh, Tanya's here. Okay, hi, Tanya. I don't know where you are, but hi. So a review engagement is a lesser standard of assurance work. The testing requirements aren't as in-depth. They are still going to try and get a comprehensive understanding of the basis of accounting, and they are still going to provide a review letter and report to management, but they're not going to look at as many transactions. So are there any questions about audit or review right now? So let's just, I want to go back one slide just real quick. One of the things that drove me nuts when working with auditors before I understood the why was asking questions. So like we of course, doing compiled financials, we're not supposed to dig into the detail, even though we know how. So you might get questions for like an invoice that's attached to a transaction in QuickBooks Online. And that is just the accountant trying to protect their level of engagement and involvement to make sure that they're not getting offside with CPA. Carol, I see you. I'm going to come back in one moment. Another thing that often happens is they'll ask the same question more than once, sometimes the same person, sometimes to a different person, and what they're looking for is inconsistency. Some auditors can be a little bit overzealous in this regard, but I mean, this is what they're doing. It's like adjusting entries. Sometimes they're just trying to prove that they're doing something, right? So that's kind of where it comes from. Carol, go ahead with your comment or question.
So I'm just curious. Recently took over a file that I'm doing a catch up on. They were kind of downsized through COVID, and the accountant who had done their 2020 return, it's a mess. Like,
okay,
do I say something? Do I just leave it? Like, I was trying to figure out, there was just one example. There was a thing in there in the expense, ask the accountant, for $1,260, which turned out, long story short, to be 2 transactions in the December bank statement that she put together and put it in ask my accountant. But then the tax return was filed and it's still sitting in there and it's not in the adjusting journal entries. So when I went and asked her, well, what was this for? She says, well, you'll have to ask the client. And I says, well, it's in the bucket, ask my accountant. You're the accountant. Where did you stick it on the tax return? So I came back with from the T2 and said that, oh, it went into supplies and materials, but I have no idea if that is actually correct, because again, it's 2 e-transfers that she just threw in and then filed. So I have no idea. Like, do I just leave that stuff? And then if there's an audit, that stuff comes back on her? Or if me being, and now I am the new bookkeeper, I'm not the accountant, the other accounting office that I liaison with will be doing the 2021 and 2022 return. But the fact
Is it
that
a
I
new
know
accountant
this,
or same accountant?
Hmm?
New accountant doing
oh, new
2021?
accountant, she
Okay.
retired. I can see why she did. She was only charging $25 an hour for bookkeeping. You know, one of those.
Okay. So what I would recommend is you want to protect your reputation. You want to stay in your lane with regards to your engagement, but you want
Right.
to protect the client too. So I'd make the client aware of it. And then like you might decide to just move it to supplies and materials, or, you know, wherever it's best decided to go. The numbers might not line up perfectly with the T2. So if there is an audit or review of the file, you're going to have some explaining to do. But in a perfect world, it's the backup for those transactions that are going to matter, not where they are.
Okay.
Supplies is 100% deductible. So as long as it wasn't them paying for daycare or something like that,
Well,
it shouldn't make any serious difference.
yeah, I'm sure that it wasn't. I'm sure that it was that. But the fact that she never bothered to get the source documents to prove what the actual transactions were for, I have no idea. So it's one of those things that just makes me go crazy.
Yeah. Yeah, and that happens all the time. At least it was a small amount and it was 2 transactions. Could be a lot worse. Could be a lot worse.
Right. Okay.
Any more questions about audit or review or comments at this time? Let's move on to compiled. So the new guideline was CSRS 4200. As I said, any year end after December 14th, 2021 should be having compiled financial statements. The audience we need to know who the audience is. And there are several questions about like, will they have access to ask for more information, things along those lines that we will be checking with management. So that might not be a question that you see, you might not be involved in this process. From our perspective, we need to understand the basis of accounting, and we have to make the management sign off on the basic, their responsibility for the underlying financial information. So this is the new one. Really, the statements look quite similar. There are more notes, and then the actual letter that comes with it is quite different. And then there are more steps during the engagement for the account to follow. These are things you're probably not going to have to deal with, but I just want you to have a basic understanding. So the notice to reader statements used to be kind of general, right? Like you put them together and they could go to whoever, whatever. Compiled financials are really supposed to be built with an audience in mind. So it's something to keep in mind there. Quite often, I don't think there's a lot of value in getting statements if you don't truly need them. Statements are required, but the Industry Canada definition and the CPA definition are quite a bit different on that regard. So there's definitely some leeway there. If you have any questions about that, I would definitely ask somebody in the legal profession, not myself. So some of the general information required, and this is all contained in the corporate record book: directors register, officers register, shareholders register, shareholder ledger, or securities register. Those are all the things that, who are the key people? When were they elected? You know, when were they appointed? You know, how has ownership changed over time? The filings, the notices, and the forms that are required for like changing a director, changing a head office. Those are some things that need to be there as well. What we do find is, especially it happened during the pandemic, businesses moved and did not update their information with CRA. So that created a bit of a problem. Also need to know about any related or associated corporations, any key identifiers of the company. So the business name, the legal name and operating name can be quite different. Business number, provincial corporation number, addresses, phone numbers, emails, things like that. We'll also need to know about the major events. Big thing is changes in ownership. Quite often when that happens, there needs to be a stub period T2. There needs to be a corporate tax return from up to the point where the controlling ownership changed, and then another one continuing the rest of the year. And then of course the minute book, I'm just going to kind of like skim over this. These are some really, you know, what happened? What were the big things that happened? Sometimes the answer is nothing. But there, we do have a blog post coming out about that in the near future that will go into this in more detail. So let's get into the more of the day-to-day stuff, right? Some key questions, have the accounts been reconciled? Now, one of the areas where we see reconciliations are usually lacking is in the tax accounts. There's RC, RP, and RT, and sometimes RZ accounts. And it is important to make sure that those are done because you want to make sure they're not way out of whack with what's on CRA. That can definitely raise questions. Have the accounts receivable and payable being reviewed for, bad debt or accuracy, things like that. Have all the key schedules being prepared and reviewed, and is everything supported by appropriate documentation? And then, of course, what is the fixed asset policy, and have the fixed assets being appropriately recorded? Carol, did you put your hand up again, or is that from the last time? Oh, it's last time. Okay, cool. Just keep going. All right. So reconciliations, I'm not going to get into too much detail. I think everybody on this call knows what a reconciliation is, but ensuring that they're done is important. And sometimes what we find is, particularly with stuff like PayPal, the account won't be reconciled because it doesn't match the statement. Because PayPal's, if you're doing an import, you can end up importing pending transactions, or transactions are kind of placeholders in PayPal system, but they're not real transactions, things like that. The records need to be tied to the third-party statement, and then we need to see what is the difference? Why is it there? Things that are old need to be cleaned up. There should be nothing on there that's more than 6 months old. Check stale date after 6 months. So I have seen banks cash unsigned checks, and checks that are more than a year old, they should be stale dated if they're beyond 6 months and have been cashed. Any questions about reconciliations, or is this like grade 1 level stuff? All right, let's keep going. Old and hanging transactions. I talked about these briefly. Checks issued more than 6 months ago should be stale dated, removed. Hanging transactions are often generated by errors. No OCR technology has gotten better, but in the past, things like Dex before Receipt Bank, HubDoc, they could just go right past any locked period and just end up in the books again. And if they were misdated, they could end up in a period like 4 or 5 years ago. Things can get entered twice. Like maybe the person is taking a picture of one receipt and another, and care isn't being taken, and really they're related to the same transaction. Common with restaurants, right? Here's the credit card slip. Here's the actual bill that doesn't include the tip. Those kind of things can happen. Any questions about any of these things? I feel like I'm flying today, but I think we need to. AR, does it match? One of the common things that we see, and it's scary that we still see it, is the invoice will be sent to the customer. It gets booked into AR, and the customer sends the payment. It gets deposited into sales. So when they created the sales invoice, they created a sale transaction. When they deposited the money, they created a second sale transaction. I've seen those files more than once, and that's usually never fun delivering that information. But I think that's kind of a byproduct of people not understanding how these systems work. If it's possible, hopefully it is, you're getting good data from the client regarding deposits. So you are matching the correct invoices to the correct payments. That can create quite a headache, especially when you're doing the cleanup after the year end, because now you're going back like 16, 18 months to figure out, okay, what is the client still owed? The statute of limitations on accounts receivable, by the way, is 2 years. So you should know. And for things to be written off as bad debt, you need to be able to prove that collection efforts were made. And this is something where we see a lot of businesses not doing a great job of it. This is also a common area of fraud. So you'll see, invoices go out to a customer, and then they'll be like, oh, that's bad debt. But what really happened was the customer gave them cash, and the cash went in their pocket and never got reported. Now, the responsibility is on management for that, but it is something to be aware of. It is a possibility. So, any questions about bad debt, AR? keep on going.
Just a quick question.
Prepaid, yeah, please.
Actually, I just had that happen this week with a client where I got the paperwork and there was one on there and it was marked to be voided. And I said, oh, did the client or the customer refuse to pay? Or did the job not happen? And he goes, no, the customer paid cash and I spent it. So it always pays to ask, because even though the little sticky note says something, it might mean something completely different. So I will record it as payment received to
Shareholder.
cash.
Yeah. There you
the
go.
shareholder, one or the other. I'm not
Yep.
voting. I mean, it's a small amount, you know, like the bill's only like
That's how it
100.
always starts.
Well, no,
That's how
but
it always starts.
exactly. I mean, I can see how it can happen. You got cash, it's on your desk, yeah, and then you forget to go to the bank, whatever, blah, blah, blah.
Yeah.
But yeah, I'm not voiding the sale. It's like, no, it happened.
That would be the inappropriate handling anyway.
Yeah,
Right? You shouldn't be voiding the sales invoice. If anything, you should be writing off as bad debt or recording it as, in this situation, I think it should be recorded to paid to whoever, and then that person owes money back to the company.
yeah,
This kind of stuff can happen too with employees, especially after you have a dispersed and you know, a sales force that's working on the road. Customer might give them like, you know, $150 for a job, and they just forget to put in the invoice and they just pocket the cash. So that is another area of fraud to be aware of.
yep.
All right, I'm gonna keep running here. Prepaid expenses, really the common ones: security deposits, rent, insurance, annual software subscriptions are paid up front, and then of course retainers. These are items that would not adhere to the matching principle if they were included as expenses in the period, because they actually relate to future periods. Having a schedule is really nice. Probably one of the easiest ways to do it is to export the prepaid expense account and just highlight which each item is and check and make sure that the balances are appropriate. One other thing I like to do with the insurance policies is when we get the thing in, when the insurance is paid, we just book it all to prepaid and then just do recurring journal to move it over. Another, actually, just real quick, another item that we often see errors with is the legal and accounting retainers. So the expense comes in, the invoice comes in, but it doesn't get recorded because it's paid from retainer. It is important to make those notices, right? And to move that portion from the retainer to the expense area. And, you know, sometimes that gets missed. So it's something to keep in mind as well. Inventory, review the details. For those of you using QuickBooks Online, I'm sure you've encountered you can't lock the books if you have a negative balance. Write off spoiled, stale, or stolen items. Does the balance make sense? And does it match the year-end count? Make the client do counts. This is another area of very common fraud. So how you'll see that the fraud is happening, how you'll bring it to management's attention, is there's large write-offs at the end of the year, or there's inventory missing, significant amounts of inventory missing. Particularly in a retail setting, this could be inventory walking out the front door, walking out the back door. Now, in that kind of a setting, of course, there's going to be some theft, but you need to keep an eye on those numbers, because you probably don't want to be affiliated with somebody who is not reporting their sales appropriately and, you know, could get into legal trouble down the road. I hate to say it, but a lot of this won't ever be caught, but it is definitely one area where you can add value to your customers, especially if they have employees. So fixed assets, this is another area where we see a lot of deficiency. A fixed asset register would be fantastic. That's a list of every fixed asset, where it's located, preferably tied with a serial number or something like that, and checking regularly to make sure that it hasn't walked off the premises or, you know, being destroyed or is unusable or something like that. When those things happen, you have to dispose of the assets. I'm not going to get into the disposal journal entries right now, but it is something that we also see incorrect a lot of the time. So quite often what we see is we'll see, you know, just the transaction to remove the asset and an equal amount of accumulated amortization. Technically incorrect. So it's something to keep in mind. You know, if you have that situation crop up, speak with the accountant you're working with. You can create the fixed asset schedule and book depreciation, showing your additions, your disposals, adhering to the half-year rule, those kind of things. You don't really have to. I think a lot of accountants are going to adjust this anyway. So it's really, it's a judgment call. I know some customers really like to see that on a monthly basis. They'd like to see their depreciation allocation there regularly. So it really depends on your level of engagement, your level of comfort, and what the client wants. So that pretty much takes us, oh no, we have one more, of course, intangible assets. These are really important, very important to valuing businesses, particularly startups, particularly in the technology realm. So this could also be important for shred claims. These are things like your patents, your trademarks. Goodwill is another common one if a business is being purchased for more than the net book value of the assets. So this is an area where we do commonly see questions. So are there any questions at the moment about intangible assets? Okay, I'm going to keep flying. Loans receivable. Keep in mind the current versus long-term portion of the loans receivable. We often see this as funny, so we'll skip books and it'll be like a negative balance in the current period and a larger positive balance than we'd expect to see in the long-term loan receivable. So these are some areas to look at. Make sure interest is being recorded appropriately. Create a loan amortization schedule if you're not provided with one. That is a tool that we do have internally, and I'm considering doing something about that, like as far as a video goes or something, but I'm not sure because it can get very complicated depending on the terms and stuff. One thing to watch for is the shareholders owing the corporation. This happens like with Carol's client, whose customer took the cash. If they owe the corporation 1 year, CRA generally doesn't care. If they owe more than 1 year in a row, CRA can force it into income, resulting in a situation of double taxation. Not favorable for the client, of course, and it can definitely damage relationships if you don't bring it up. But at the same time, it's really hard to bring up because it's like, what do you mean I have to pay tax on that money? And then you have to have that conversation. So that can be a fun one as well. All right, moving on. Accounts payable, again, has it been reviewed? Is there anything double entered that needs to be, okay, that's voided? Is there anything that's completely stale dated or disputed? So the bill's in the system, but the client is refusing to pay because of lack of service or something like that. There are the odd times where in a supplier account, you can see a negative balance because there's a credit there. Keep in mind, statute of limitations, again, for accounts payable is 2 years. So that's how long it should remain. Accrued liabilities are kind of the opposite of prepaid expenses. These are liabilities that the company is going to have related to the period, but they have not received the expense yet. They haven't received the invoice. Let me just talk about accounting fees for a good example. You book the accrued liability for accounting fees, so you recognize the expense of accounting fees in the current period. And then like 6 months later, the invoice comes in. Quite often that invoice gets booked to accounting expense again, and it doesn't get cleared with the accrued liability. So that's something to keep an eye on. Lawyers are terrible at sending invoices on times, so that's something else that you'll see a lot. Of course, we're going to want to see a schedule just outlining the balance of the account, what's in there and why. This is an area sometimes there are questions. Are there any questions about this? Keep on going. All right, loans payable. It's pretty much the opposite of loans receivable. If the shareholder is owed money by the corporation, CRA generally doesn't care. In my opinion, it's important to keep track of which shareholder individually, because we have seen situations where one shareholder owes the corporation money, the other shareholder is owed money by the corporation. And what effectively has happened here is one shareholder is financing their lifestyle on the backs of another shareholder. It's inequitable and inappropriate, but what we commonly see accountants do is blend those together. And as long as it's like net payable to the shareholder, they just kind of ignore it and put it in there. And that's not appropriate at all. So it's something to keep in mind when you're doing the books, if you have multiple shareholders involved. Most loans should have an amortization schedule, or at least the information you need to create one. So making sure that the interest is booked appropriately is important as well. And of course, the long-term and the short-term portions of it. So this is, I mean, we've all seen this. Has anybody ever seen a file where there's no shareholder loan transactions? Really? Must have been a really good, well-run organization, Kathy. I don't get why people do this. Like, I mean, yes, I know at the beginning, sometimes there's a need, but really what they end up doing is paying for work they don't need to pay for by having this blending, right? They're paying us to track how much they owe the company. They're creating an unknown tax liability that's harder to manage. Those are some things where, like, really discouraging the entanglement is very important. Essentially what happens if there's a debit balance multiple years in a row, it doesn't always get caught, let's be honest, but if it does get caught, what CRA can do is force it into regular income for the individual and not allow any kind of tax deduction for the corporation. So the corporation pays 12.5% on that balance because it's not a tax deduction. Okay, 12.5%, not a good example because this is a nationwide audience, but for instance, and then the individual pays personal tax on it as well, resulting in more tax being paid than what really needed to be done. Quite often we see a lot of attempts at fraud in this area. We generally don't work with companies that are doing that or individuals who are doing that kind of thing, but I'm sure everybody's seen here and it's like, oh, all these groceries are business expenses. Oh, this pet food is a business expense. I'm sure we've all seen that kind of stuff. And like, it's something to keep an eye on, right? Because, you know, knowing your customer and knowing your comfort level and things like that, I'm sure there's somebody who'd be happy to take this kind of unethical customer, but for us, we'll take a pass. So taxes payable, this is the area where we see the most common is being incomplete. Understanding how QBO functions makes it very easy. We have been working on like a really good system of doing CRA account reconciliations going back. I almost think we need to start petitioning the government to have CRA change the way they report their account, because even as financial professionals, it's difficult to understand. Once you understand, but at the beginning it can be challenging, and when you're teaching people, it can be tough. The differences between the accounts need to be understood and explained. And what you're really looking for are big variances, because CRA will look for that, right? If you file the tax return and on the tax return, it says you owe 120,000 in HST and then your next filing is 10 grand. Well, that's a pretty big discrepancy. It may result in the client getting looked at. We did have a client who this happened to recently. We're working through it. And, you know, sometimes you can't help what the client does. And it's kind of one of those situations, but doing it once, doing it right, that's the best way to do it. Just a comment, a caution about doing entries directly into the GST HST payable account probably shouldn't be done. It's very rare that you should do that, and generally speaking, it's going to screw up your filings. Equity transactions, these are very rare. Keep in mind though that sometimes there can be trigger events that will convert a loan into equity. So sometimes you need to be aware of what's going on there. You need to have the loan document. And if that trigger event happens, then you need to speak with the accountant about it. I definitely would encourage bringing more eyes to the situation unless you feel confident in making the entries. If you are confident in making the entries, do it, but make sure that you provide them with the support, because in the end, the client will need to sign off on it. And I'm sure everybody here, their clients tell them everything, and then it's never been a situation where it's like, oh, there was an extension to that agreement, so the trigger event didn't happen. You know, I'm sure that never happens to anybody here. So just hop on the check through. Kathy deals with a lot of not-for-profits. Yeah. Can't have a shareholder loan account going around in a not-for-profit. Finally, the dividends paid need to be recorded in the books and the minutes, and you need to issue the T5 if that has happened. Try and understand what eligible and other than eligible dividends are, because those can impact on the personal tax side, depending on what you're filing. Any questions about the balance sheet? All right, I'm sorry. I feel like I put way too much content into this. So I'm just gonna have to run through. Looking at the income statement, we spend all our time on the balance sheet. That's where I would say 80% of our time is spent. We do look at the income statement, but what really we're looking for are like big problems. Are there big variances between, different periods? Is passive income being split out appropriately because it is taxed at a different rate? It does have an impact on the purity of the corporation if the customer is moving into a sale position where they're going to exit the business. Legal and professional fees need to be reviewed, and of course documentation, and we'll get into all this as we. So passive income are things like licensing fees, royalties, and rental income. They need to be separate because they're taxed differently, and these can really make a company very valuable if there is, like, say, a lot of licensing fees for IP that they hold that is being paid for by an outside party. This can really encourage the value of the company. We don't really deal with a lot of properties on the corporate level, but rental income is one of those that might happen. Product sales, services, those are active business income. Understanding where it's happening is important. I'm not going to get into the rules of provincial sales tax, but if your customer is selling into a province, you need to understand, and they need to understand and charge sales tax appropriately. Similar with selling into the States. That Wayfair decision has made that very challenging, but Avalara has a great tool to help you determine nexus if your client has economic nexus or what the thresholds are. I have yet to see any app partner or any service out there that really automatically triggers these things. I think most commonly it's encountered in e-com, or in e-commerce, so it's something to keep in mind. Another common area of fraud where the sales staff sells a product or takes a product, pockets the cash, things like that. Watch the inventory shrinkage levels on product sales. It's often a sign that there's something not right. The big thing to understand with services is how many customers does the corporation have? If your person is a contractor for Rogers working in a corporation, they're a personal service corporation. It's not eligible for small business deduction. It's something to keep in mind. There's a lot of misinformation, like my buddy says, my friend says, things like that. I literally had this conversation last night with somebody. Oh, my friend said I should buy the car in the corporation. And then we had to have that discussion of what are the implications of that. I really like using the time tracking. So we have QB Time. We're not connected from QB Time to our QuickBooks Online, but we are using QB Time regularly to review where is our time going. And it's sad to say that lately a big part of that is going to support calls to deal with issues with different software products and stuff like that. But this is important to understand when time is a key factor in the ability of the corporation to make money. Legal, accounting, and professional fees, all of these invoices should be reviewed. Sometimes, very common to see a shareholder have the same lawyer for the divorce as they do for the corporation, and they'll send the invoice in and try and claim it as a business deduction, which it is not. So watching for personal is important, but watching for structural is important too. Sometimes this work has to do with spinning off a new corp, a business that is not this business, those kind of things. So these are things that should be looked at all the time. And if you're not getting asked for them, then you might want to wonder why. Right. So everyone knows about meals and entertainment and the people who are trying to claim their groceries and their pet food or their morning Tim Hortons run, things like that. Does everybody understand the difference between a business expense and a personal expense with regards to this kind of thing? I'm seeing nodding heads, so I'm going to keep going. CRA has administrative requirements. This is interesting. So the gifts they're onto. The real estate agent who goes to LCBO, buys $5,000 worth of gift cards, says they're all gifts, and then drinks on their business for the rest of the year. CRA is onto that. So that register, yeah, I know, Carol, you're disappointed, but the look on your face. But keeping that register is important. Keeping a schedule of where those gifts went and providing contact information is important. You know, one thing that's interesting here is this is an administrative requirement. It is not law. It is not law. So if you go and you look at the actual case law, there are some situations where CRA has been overruled and a reasonable expense has been allowed. Same with vehicle expenses and the mileage log. My opinion is just do it once, do it right. Who needs to get a lawyer to deal with CRA about these issues? If you just keep a mileage log, you save yourself thousands of dollars on lawyers' fees, right? Another common area we've seen problems with is personal vehicle expenses flowing through the corporation. The corporation doesn't own the vehicle. CRA would prefer the mileage chargeback rate. I'm a big fan of that because it's relatively simple. It's nice, clean separation. And quite often, unless you know the individual who's charging back the mileage is driving a really fancy car, they're often getting more recompense from the corporation than they are incurring cost. So something to keep in mind. Be aware of how you're claiming the HST on vehicle expenses. One thing we see all the time, and we see this more in the construction category, is regular auto fuel going into equipment fuel. And we've had to talk to a couple clients about this and just be like, listen, are you looking for a problem? Right? Like last year, before, when we told you that you couldn't write off your auto fuel, your equipment fuel was this much, and now it's 12 times the size. CRA is going to notice that. They're going to have some questions. Do you want them digging around in your books? So again, I would just be cautious about who owns the vehicle and how is that being tracked. I love mileage trackers. I use the QBO app to monitor my mileage. It's not perfect, but I really don't drive for work very much. Another thing we see that we will sometimes absolutely miss is penalties and interest being booked into interest expense. This needs a separate account. It's not deductible. And it's not our responsibility to go and look at the interest expense account. So if you're putting CRA interest in with interest expense, regular interest expense, you're offside. It's that simple. Other things that can't be claimed are like, ministry fines, moving violations, those kind of things as well.
But vendor interest is okay, correct?
Vendor interest is okay.
Okay.
Loan interest, vendor interest, recording your interest earned should go into interest earned, not into interest expense. We see that a lot too, where it's like, oh, I'll just offset here. If it's credited back, like say it's credit card interest and they credit back some interest, that's fine. That's where it belongs. But let's say it's mainly credit card interest and then, they get interest from the savings account and you blend them. That's not appropriate. It really needs to be split up. All right. Hey, we made it. Poll question 2. And I'm going right back to the beginning. Which of the following are considered financial information? I really didn't think we were going to get through all that material.
I think I got it right this time. Everybody should be able to
Looks good to me.
answer. Okay, so we're at 70%. And just a reminder, in order for the continuing education credits, I need you guys to answer both. I will track those in the chat from earlier. So I'll give you a few more seconds. All right, we're going to close that off. How's that?
Not bad, not bad. The answer is A and B. Compiled financial statements are considered financial statements I'm going by the CPA definition here, but they are considered financial statements, whereas anything else is really considered financial information. So the reports out of your QuickBooks system, corporate taxes, T-slips, things like that. All right. So today we spent a lot of time actually talking about the level of engagement required. If an audit or review is not required, avoid it. When your managers are dealing, like the managers of the client businesses are dealing with different outside parties, one thing that we see sometimes is they'll make promises that are stupid. So I once worked for a mortgage company before I started CATA, and the CEO promised the shareholders they'd have audited financial statements monthly. It was ridiculous ask in the first place. B, to make that kind of promise without speaking to your CFO is just plain stupid. Needless to say, that did not end up happening. Audited financials were produced annually as was appropriate by the bylaws of the corporation. The rest of the stuff, we really, we've covered it a few times in different presentations. All of them are on Tanya's YouTube channel, but it'll be interesting to see how those have evolved over time. Really, it's, understanding what's going on in the business, understanding what is required to keep up to date with the business. Those are some key things that we'd like to see improvement in small business for, updating that minute book annually. It doesn't take a lot, but it gets ignored all the time. Having accountants who are doing compiled financial statements as part of an engagement and charging like, $4,000, $5,000, $6,000, $7,000 and doing this extra work that isn't even required. And quite frankly, without an audience is probably not appropriate. So these are some things to think about. Anyway, that brings us to the end. Please connect. I love to connect with people. It's nice to see some familiar faces. I haven't seen in a little while. I haven't seen Kathy in a while. I haven't seen Bori in a while. Shalin. Shalin. I don't know if I'm saying that right, but nice to see everybody. Are there any questions or anything, stories, crazy stuff your clients have done?
You need to change your headline on your bottom of your thing with all your letters now, because you're a CPB, not pending.
Oh, are you talking about oh yes, that's very true. I actually prepared this presentation. So I actually usually prepare the presentation in the first week of the month.
Right.
So I can get it to Tanya, so the poll, so
yeah.
They can get it to CPB and things like that. So I actually hadn't written the exam at the time. So yeah, but
well,
I will
can
update
change
that
it.
for sure. Yeah. Any other questions, comments, concerns?
I think Jennifer had her name up.
Yeah.
So passive versus active income, if it's the corporation and all they have is rental, and like they basically actively do rental because they do all the repairs and all the everything, is that still considered passive income? Or
All right, are we still recording?
Yes, we are.
Okay. So one thing that yes, it is considered passive income. If there are additional fees charged for the property management services, that portion would be considered active income. Common structure that I've seen, and again, we don't deal with a lot of corporate rentals, but one thing we've seen is the corporation holds the rental properties, and then those are held, like that corporation is held by a holding company, which also has an active business that does property management, and they strip the profits into the property management company. Whether or not that's appropriate, I think you'd probably need to talk to somebody who's like more of a tax specialist with a bit more knowledge than I have. But yeah, rental income is not active business income. Doesn't matter how many you have.
oh, okay.
Yeah.
Because
We actually got fired from a couple clients for that. Yeah.
oh, okay.
It happens, right? Like people sometimes shop for answers. It's like, well, I don't like your answers, so I'm going to go find the answer I like, and then I'll work with that person. It happens a
Well,
lot.
this is just kind of new. Like they
Yeah.
had a corporation that had a business. They sold that business, but they've moved all their personal rentals into the corporation. So there should be another corporation that essentially pays them to manage those.
It could be. I don't think it would work out with one property. So that's something. to
No,
keep
they
in
have
mind,
like
too.
5.
Oh, yeah.
No,
then
yeah,
that
it's
could be,
5. That's just kind of they're senior. I mean, they're just older than me, right? They're not ready to like curl up and retire, but they've just bought these 5-unit, 7-unit, 4-unit properties. Like it's not even
That's
just
awesome.
one house or anything.
That
yeah,
is
and
fantastic.
they've owned them for years, so that's kind of what they're doing now instead of the day-to-day business that they had. So just want to make
Now,
sure
something
that
to keep in mind is our system is built on this principle of equalization. So essentially what happens is those passive incomes are taxed at the highest personal tax rate. When profits are dividended out to the ownership will pay tax on it, whatever their tax rates are. And the corporation actually gets some of the tax back. That flows through the RDTOH account, the refundable dividend tax on hand accounts, which is definitely getting into the accountanese. But essentially, it's saying like, this
Okay.
portion of dividend is eligible for a tax refund that will come back from CRA. So in the end, what CRA would like to see is roughly the same tax rate being paid, whether the money is in the corporation or in the individual sense.
Okay. Thank you.
No problem. Any other questions, concerns, stories?
All right, I'm gonna jump in and thank you, Jonathan. Thank you
Pleasure.
for participating as always, and thank you for bearing with me as I fumbled my way through.
Not a problem at all.